Well, welcome to our informational webinar, and we are pleased that you chose to spend this time with us. My name is Grant, and I'm your host. At GolfSuites and ERC Communities, we're about diversity in investment. So I'm very pleased to have two experts speaking on this webinar on that very subject. So stay tuned if you're looking to diversify your current holdings. Now, first, I'm very pleased to introduce Ramez Fakuri from the IRA Club. And Ramez is an entrepreneur with more than 20 years of experience providing service in various settings, including hospitality, industry, financial services, and real estate. And as vice president of the IRA Club, his mission is to open doors and opportunities by educating, inspiring, and allowing our investors to diversify outside of the norm. Welcome, Ramez.
How are you, Grant? Pleasure to have me. And thank you, Jerry, also for bringing me on board for one of your great and educational events. One of the things that I absolutely love as we collaborate always together is the opportunity to open up doors, right? And that's what we're here to do, is to educate you. And in particular, what it is that we do here at the IRA Club is the power of a self-directed IRA or solo 401k. We're going to talk a little bit about control, how to utilize a portion of your retirement funds in the alternative space. Grant, thank you for having me. Jerry, always a pleasure.
We thank you for being here and taking time out of your busy schedule. And then, of course, we also have Jerry Ellenberg, and Jerry has more than 40 years of experience in real estate, finance, and development. Now, he was the founder and general partner of LCAP Manufactured Home Communities, acquired more than 100 properties, totaling more than 40,000 rental units across 26 states with over $900 million in transaction value. Man. His expertise includes accounting, and as a CPA was the founder of a public accounting firm specializing in finance and taxes. And he has a vision to create an engaged collective of investors, bringing to light his unique combination of financial and operational experience. Welcome, Jerry.
Well, thank you, Grant, and hello again, Ramez. Happy to be here. I hope I can live up to that illustrious introduction there, Grant.
Well, you better. We're going to have to take your camera off.
I'll do my best. I'll do my best. It's great to be here with you producing this, Grant. Of course, with Ramez again. Ramez and I have done a great number of these joint webinars because we at GolfSuites are working exclusively with the IRA Club on self-directed IRAs and 401ks. We are at a point now where we have investors. We are referring investors over to the IRA Club and coming in with investment capital literally multiple times a week at this point. A tremendous IRA facilitator. They work very efficiently, have a wonderful crew, very tight, kind of a family business that just works very well. So we're really pleased to be joining together in this. Ramez will give greater detail on how the IRA Club works and some real good input on self-administered IRAs as we move along. Let's talk about GolfSuites first. This slide essentially says what we are doing. We are developing, building, and operating what we call golf entertainment and dining venues. I think a good majority of the people who will see this webinar are familiar with a company called Topgolf, particularly if you live in major cities around the country. We are essentially cloning that business plan. It's a very well-proven concept. We're probably now the second largest in the country in this venue, where we take a golf driving range and merge it together with a sports bar with good high-end sports dining and entertainment, multiple TV screens, and where you have a situation where people can hit golf balls with technology support, so they can pretend they're on St. Andrews or Augusta or Pebble Beach while they're at the driving range. While they're doing that, they can be served wonderful food and beverage items and stick around when they're done for any of our bars or restaurants that are there. It is one of the newer versions of what's called entertainment. It all started decades ago when Nolan Bushnell came out with Chuck E. Cheese, and it came around with Dave and Buster's. Topgolf took off on this with golf. There's all kinds of different companies now that are doing this. We're very intent in this golf venue because it's a nice combination of athletic workout as well as good food and beverage entertainment. The GolfSuites investment has a couple of key features I want to go over. And it's driven largely by a very major economic factor of supply and demand. But now, with the new millennial generation, all this post-baby boomer and post-World War II, 50% of golf is now participated off of golf courses. 30, 40 years ago, it was 100% on golf courses. But the traditional golf round today is still a 6 or 7 hour deal, and takes a lot of family time away. And so these alternatives have come about where a husband and wife could take their kids, perhaps spend an hour, hour and a half. Everybody's hitting golf balls. Everybody's having a good time, and back home they go. So it's a new genre of this form of sport, and it is in this country. And I'll get into this a little later. In this country, at this point, extremely undersupplied. The demand-supply equation is just terribly out of balance, which obviously lends itself towards exploitation for companies like ours to get into dozens, hundreds of cities around the country and get these things built, get them opened. The two key elements of this investment are the fact that we pay an 8% dividend, which is largely tax deferred, which means it's not currently taxable due to various tax advantages we have in our corporate structure. This 8% dividend now has about a 3.5-year history to it. It's paid every quarter. A tremendous number of our investors now opting to reinvest those dividends. They've been so happy with it, but our investors can either take their dividends by check, take them by ACH, or simply let them ride and be reinvested for additional shares. On top of the 8% dividend is the ownership structure wherein these shareholders are buying preferred stock. I always ask attendees to these webinars to go onto Google and look at preferred stock so you really see what that is. Essentially, preferred stock is first money out. We founders and members of management, of course, own a lot of shares in this company, but we don't get a dime of money out of anything unless and until 100% of your capital and these dividends are paid back to you. In addition to that, the preferred stock has what's called an equity conversion rate right, and you thereby get the greater of the amount you invested or what your ownership would be worth had it been common stock. So this is convertible preferred stock, a very important term for everyone to remember. And as always, I and many of the people in my company are available to discuss this in personal Q&A if you'd like further information. So the key basics: tremendous out of balance supply demand, tremendous surge now of modern day families going to this form of golf entertainment as opposed to traditional 18-hole golf courses, and then a tax deferred 8% dividend, preferred stock first money out with good equity conversion rights. That's basically the deal. Go ahead, Grant. What are some of the drivers here? I hit on this in the last couple of minutes. New golfers are looking for more affordable, less time consuming, and interestingly, less intimidating ways to embrace the game. Of course, intimidating meaning that they may not feel that they're good enough golfers to get out there on a major golf course. Technology is allowing players to come to GolfSuites and either just hit the balls out into the field or turn on the computer screen and play 18 holes of any golf course of their choice in, say, an hour, because the radar technology tracks their ball and tells them how far they are from the green and right down through a putting scenario. We feel that although 50% of the golfing public is using our kind of facility now, that's very much in an upward trend. You go to Topgolf at peak hours, you go to GolfSuites at peak hours, Thursday afternoon going into evening, Friday afternoon going into evening, all weekend long, tremendous wait times. We obviously love seeing those wait times. We do a very good job of entertaining our guests while they're waiting, but it is, again, an extremely undersupplied scenario here. Where are we trying to build? The picture, it's an interesting picture you see on the right-hand side. That's our first location that we opened in Tulsa, Oklahoma. Very picturesque place right on the Arkansas River. We are going for secondary markets wherein we can build these locations more cheaply and open them faster. I am essentially a fiduciary. I am the closest thing what you could call a trustee for these shareholder capital. And I have decided I want my shareholders' capital spread to a number of locations as opposed to being concentrated into any single one. We could save up money to build a $25 million location. Conversely, what we are doing is we're doing $5 million locations. I like that geoeconomic risk. I like having an investor with shares end up being in 40 locations instead of 7 or 8. That's just a personal bias of mine. Speed to revenue is critical here. These things build faster, they open faster. What is it we would like to do? Well, we'd like to do a couple hundred of these over the next decade, and we think we can. The management team that I've brought in, very heavy expertise in food and beverage. We have a former Topgolf executive with us who opened 30 of their locations, left that company to come with us. All of the members of the management team come to us with tremendous volume of development and opening new location history. Our president comes from the Cracker Barrel restaurant chain. In his tenure there, he oversaw the development and opening of 200 of their locations and was sitting on top of 76,000 employees across 650 locations, doing about $4 billion a year in volume. So we have a tremendous growth immunity, is the term I use in this company. No hesitation, no timidity, as it were, to growth. Right now, we have 2 sites in development. We have 3 operating, 2 in development. We'll probably have moved to 4 in development by the first quarter. And during 2023-24, you should see us hover in around 3 to 5 developments at a time in development, in construction, and opening. That will then increase to 8 or 10 as we move down a couple more years. 200 locations averaging $5 million a year of revenue would give us a $1 billion annual revenue facility here at the end of the decade. Okay, why invest with us? Number one, we are not a concept anymore. When we started this, we absolutely were. When we first started selling shares, this was simply a concept offering. We are now operating 3 facilities in excess of $10 million a year gross revenue. Our net cash flows from our existing locations are much greater than the dividends we are paying. I think that that is a factor for investors, the fact that you're not investing in just an idea, but you're investing in an idea that is now backed by actual operations and profits. We have a tremendous ratio of repeat investors. This is something that quite surprised us. We have investors coming into this investment now 5th, 6th, 7th time, and in many cases for greater amounts than their earlier investments. Point 3, the GolfSuites management team brings over 100 years of combined experience in the actual skills that are needed here, the technology of the golf entertainment, knowledge of the golf industry, combined with superb food and beverage management experience. And then number 4, I already touched on this, an aggressive yet responsible, a term you'll hear me use often, aggressive yet responsible development plan to get this brand proliferated out as fast as we can. Nick Flanagan, who's our president, comes over for Cracker Barrel. Any of you who may be familiar with that brand may recognize that virtually every single one of those Cracker Barrel restaurants are precisely the same, much like Southwest Airlines, which only flies 737s. They fly one kind of airplane and one airplane alone. We can be likened to those 2 companies, and you will wake up in a few years and see 30 locations. The last 25 of them will probably all look as much the same as they possibly can, with, of course, the variation for some of the geographic traits that we would like to develop. So that's basically why you'd want to invest with us. Here's the how-to. Go to investors@golfsuites.com or visit invest.golfsuites.com. And, you know, we are very easy to gain access to. Our telephone numbers are blasted all over these websites, and you get on our email mailing list, and you can be caught up on all kinds of our current events that are ongoing. But that's basically the GolfSuites story. We'd love to have you join us, and particularly with my good friend Ramez here today. If you want to do this with IRA funds, it's just a wonderful opportunity to tax shelter all of the profits and gains you'd make with us. So with that, Ramez, why don't you take it away?
Jerry, thank you. And just for those of you who are actually listening to us for the very first time, I have actually personally myself invested with GolfSuites. I'm talking about not retirement funds, but my own personal funds. The location in Tulsa that he mentioned is absolutely stunning. That's what actually closed the deal for me. As Jerry mentioned, one of the things that I do love about him and his team is they put education as the forefront when it comes to educating their clients, right? So with that being said, what is it that we do at the IRA Club? We are a Chicago-based company. All right. So we are going to talk about the power of a self-directed IRA. Can you guys see this by any chance?
We can.
Yeah,
there we go. Just want to make sure. All right. So we are going to talk about the power of a self-directed IRA. As I mentioned, we are a Chicago-based company. Company overview. We've been here for 15 years, started by a gentleman named Dennis Blitz, very well respected in our industry. We currently administer 12,000 IRA club members. We manage about $1 billion under assets, in particular, the retirement space, and we deal with alternatives for the forefront or the most part. We have 35 employees, full and part-time, and our company overview. And if you guys want to go ahead and pull out your phones, I am going to have a lot of charts on the graph. Some of the numbers might be a little bit small. If you like to pull out your phone, scan it and follow along with me. But the company overview as a whole, when you think of IRA Club, and many people ask, have never heard of a self-directed IRA company, I want you to think of IRA Club like a Fidelity, Vanguard, Schwab, or TD Ameritrade, where many of you may have retirement funds, an IRA, a 401k, 403b, a 457, a TSP with your current employer. The problem is, when you have your funds with these traditional brokerage firms, they're typically tied into the stock market, right? Stocks, bonds, mutual funds, ETFs. So the question that I like to ask you is, how do you think you guys are doing? I'll tell you from now, and we're going to get into these numbers a little bit later. I'm pretty sure everybody knows they're taking a big hit with the market volatility as interest rates go up. And they're going to continue to go up to battle inflation. And we got to get that number down, although it did come down as of yesterday to 7.7%. We still got to get it down to the comfort zone of 2%. So with that being said, expect the markets to stay unbelievably volatile. But I want to talk about retirement accounts in particular, and the fact that we are in trouble collectively as a country. Why am I saying this to you? If I tell you there is a stagnant number of 64 million IRA accounts across the country, right, of which only 1.8 million have $1 million or more, and 60 million IRA accounts have $1 million or less, that is far and few between. So my question to everybody that's listening is, what are the 1.8 million accounts doing right that these 60 million accounts are doing wrong? And the answer is really simple. They are taking control of their retirement, and in doing so can create long-term wealth for not just themselves, but their family members. So the point that I'm trying to make is, number one, you could not save your way to retirement. You have to invest your way to retirement. And number two, and most importantly, you have to take control. Our biggest concerns and problems that we face within a company as we educate our clients is lack of knowledge. You have no idea how many investors that we meet at events. As I travel all over the country, just this year alone, in the last, I believe, 4 months, I think I'm at like 50 events, live events. I'm not talking about podcasts or webinars. And you'll be surprised to know that I would say about 10 or 15% of the room has ever heard of a self-directed IRA. So lack of knowledge is number one. Two, the biggest challenge that we also face is identifying investment opportunities. The self-directed space, again, self-direction is just a marketing term that we use within our industry. Self-direction, again, I'm going to hear me say this word over and over again. I don't want to sound like a broken record. Control is the word that I want you to take away from this. Accredited versus non-accredited, all right? For those of you that don't know the difference, accredited just means you make over $200,000 a year, or if you are married or have a spouse, that's $300,000, or have $1 million in assets. You need to be able to prove that for 2 consecutive years. So the majority of Americans, 90% of them, are non-accredited. So when I do attend these events, they want to go ahead and get started, but they don't have an actual investment opportunity that they could look at. So it's hard for them, number one, to identify, or where do I look? And that is the reason why I personally love GolfSuites, it appeals to both sides, the accredited and non-accredited. So when I do educate, I also want non-accredited investors to not feel like they're just tied into the stock market. The other concern that we always hear is from fiduciaries, brokers, registered investment advisors. Not that I have anything against these individuals when they're working in your best interest. The truth is, probably 60% of them don't even know what a self-directed IRA is. So one of the things that they tell you is too risky. If they have heard of it, too risky, don't do this. You're going to go ahead and lose a lot. I would argue and say, you're not doing too well this year. So with that being said, and we're going to go into the fee structure a little bit later because that's very important to us, but I want you to understand the history of a self-directed IRA or where IRA comes from. So before the 401k, before the 403b, before the 457, before the QRP, they all got adopted, or some sort of abbreviance of an IRA is where I personally feel it's been hijacked. The retirement account. And I'm going to go into that in greater detail. So established in 1974, it was really to address pensions. Government knew as people started getting older and older, Congress needed to battle what the other government programs that are now taking a drastic hit, Medicare, Medicaid, and Social Security. Last year, we got bailed out at $2.2 trillion. This is not sustainable. They have to address it at some point or another. Otherwise, we're not going to have these government programs to help us as we get older. Two, today, there's only $40,000 within all qualified retirement accounts. Social Security is about $1,500 before taxes. Social Security, on the other hand, when it first established in 1935, there was 24 workers for every one retiree. Today, that number is 2 to 1. By 2030, that's going to be 1 to 1. Which means there's a lot of strain, again, just on this one specific way that we depend on retirement, and something that we need to do and address as the years come through. Now, 28% of Americans over the age of 55 don't even have retirement funds. And to make matters even worse, when you take a look at America's wealth, most people do not know this. When you think of U.S. wealth, it sits within retirement accounts. $33 trillion. When you take a look at Gen X's and baby boomers, that's the majority of that. The silent generation, Jerry, I want to be respectful to you. I don't know if you fall into that category.
I think I do.
I think you do, but you know where I'm going with this.
And I should act more accordingly, I think. The word
and you should. But the point where I'm trying to get is the millennials. 4.6% of them. That's it. Of the $33 trillion, 4.6% is held within millennials. This is more strain on our Social Security. Now, nobody needs to be living underneath a rock to know where inflation is, okay, and taxes and where they're heading. I just mentioned the CPI report just came out yesterday. It did drop from 8.3 to 7.7. It doesn't matter. The reason why I'm telling you this is because inflation isn't going anywhere for the next couple of years. It's working against you. But this is what I find to be funny. Inflation, Jerry, is at 7.7%, right? But our day-to-day lives, if you take a look at everything that we need to live, rent, gas, food, cars, is all in double-digit double-digit numbers. So when I think of 7.7%, I think this number is very skewed. All right. I think it's much higher than 7.7%. Why am I bringing this to your attention? If you take a look at the numbers, the average American spending just over $550 per month. All right. Again, a little under $7,000 per year. So how do you stay ahead of inflation? That's the $1 million question. And the answer to that is very simple. You have to diversify your portfolio. And I'm not just talking about your personal dollars. I'm also talking about retirement dollars. Okay. That is what the ultra wealthy do. That's the reason why I talked a little bit about accredited investors, because they're the ones that are really utilizing this. And with Jerry, you have an opportunity into diversifying the alternative space because he's giving you that with his Reg A offering. So he deals with both accredited and non-accredited. So you can't have, the point of this slide is real simple. You cannot have that mindset anymore of set it and forget it. That's out the window. Let me make that very clear, especially for the next 5 years. All right. You have to diversify your portfolio. Otherwise, you are going to keep working for the rest of your life. Number two, taxes. And the reason why I'm addressing taxes is, and I'm going to get into this a little bit in more detail, we need to face reality as Americans and more so as investors. Okay. Biden's Inflation Reduction Act just passed 2 months ago, which basically states we need to come up with $4 trillion in the next 10 years. Otherwise, inflation is not going to get down as fast as they want it to. How are they doing so? As he promised within the Inflation Reduction Act, only the people within the highest tax bracket and corporations that are making over $1 billion are the ones that are going to be affected. So a corporation making over $1 billion in net income is going to be taxed 15%. For the ones that are making over 540,000, it's going to drop down to 400,000. They're going to raise it from 37% to 39.6%. And this is how they're going to combat the problem with Social Security, is by raising it to 12%. So for people in the highest tax bracket and corporations, this is the way that they're going to try to offset it. Now, he did promise with the Inflation Reduction Act that he is not going to be raising taxes on the middle to lower class. But instead, and I consider this to be a slap in the face personally, is he's going to supercharge the IRS with $80 billion to go with to empower 87,000 new IRS agents to go after the middle to lower class. So I'm not going to raise taxes on you, but I'm going to go harass you to go get the money. And when I say harassment, if you look at the income brackets, you're talking about triple digit numbers per year. So when you look at 1 to 25K, he's really targeting people in the hospitality industry that do get paid by, instead of check, cash, versus the ultra wealthy. Now, if you take a look at these numbers, they're in 42, 42, 5. And now, granted, you know, there's not too many of us that are making $5 million or plus, but the point that I'm trying to make is they're already going to get their money from the ultra wealthy. So they're not going to be harassed because they did raise the rates. When you think of IRA club members, and all, the majority of the people that we do work with are accredited, although that ratio is changing drastically this day and age because nobody wants their money currently in the markets. Taxes will never be cheaper than where they are today. Bottom line, all right? They're only going to go in one direction. That's because we have a progressive income tax, and they have to, again, battle inflation. You cannot put $13 trillion into the economy and think that taxes at some point in the near future are not going to go up. And the answer to that question is really self-directing. So before you leave today, I want to ask one thing. How safe is your retirement? Because you know that everything across the board is working against not only your personal funds, but your retirement funds. IRA clubs allows you to diversify your portfolio into the alternative space, where Fidelity, Vanguard, Schwab, TD Ameritrade, your broker, or your other 10,000 brokerage firms that you're dealing with are not going to allow you to utilize a portion of your retirement funds to invest in what you know and understand best. With that being said, I have no idea why it jumped 2 slides ahead, 3 slides ahead. I'm so sorry. I do want to talk a little bit about who is taking all of the risk. Wow, it really did jump. I'm sorry, guys. My apologies. Who's in the driver's seat? So when I say who's in the driver's seat, what happened to your IRA? What happened to your retirement? The problem is, as I mentioned, if there's $33 trillion sitting in retirement funds, they're traditionally held in 3 places: banks, annuities, and the stock market. Now, as of yesterday, because the rates went up, it's actually bank CDs are at 4%. Annuities still hover between 3 to 6%. I'm so sorry, 3 to 5.2%. And the market for the last 15 years has been generating you about 8%. Why am I bringing this against your attention is only 3% of Americans actually self-direct and have control of their retirement funds. So I'm not going to talk about CDs because I personally think anybody who's listening to this and educating themselves on the topic of self-directing, number one, are looking to do better for themselves. And I highly think that you could do better than 4%. I am going to talk about annuities just a little bit. All right. There's 2 different types of annuities. There's the fixed income annuity and the variable income annuity. There has been so much money, and I mean marketing funds, sent over from insurance companies for people traditionally with the age between the ages of 45 and 65. Why? Because they're the ones that are holding the majority of the funds, traditionally over $100,000. And what they're pitching is, Why worry about market volatility anymore? Why don't you go ahead and roll that over to a fixed income annuity, and we're going to guarantee you 5% for the rest of your life. That's the pitch that they're giving. The problem with me personally is they're the largest commission base upfront. Most people do not know this, okay? Annuities are not government programs or products. They are an insurance policy. So in that case, they are not FDIC insured. So God forbid something happens to that company, you lose everything. Agents are more salespeople. They do not understand what is being offered within these annuities. Their job is to sell, sell, sell. And at the end, they always win because God forbid something happens to you, they take all of your retirement funds. It's not passed along to your heirs. Make sure if you do have one, it's structured to at least your wife. And again, do your research and due diligence before you jump into them. I personally do not like them. At the end of the day, I leave that up to you, but make sure you know what you're getting yourself into because you're not in control and there are super high surrender charges once you give that up. If you break down the numbers, assuming you're 60 years old, okay, and let's take down the highest. So I told you it's about 3% to 5% for a fixed income annuity. And assuming I'm going at the highest bracket of 5%, if you wanted to roll over a portion or all of your retirement funds into an annuity, assuming it's 50,000, 100,000, or 250,000, these are your monthly payouts for the rest of your life. My question is to you, can you live off of $211, $421, or $1,000? And I'm pretty sure the answer is no. But I do want to concentrate on these companies because I refer to these four, as Jerry knows, the four horsemen within our industry: Fidelity, Vanguard, Schwab, and TD Ameritrade. They control just under 70% of all retirement accounts. Fidelity being the forefront, they control 33%. And for those of you that don't know this, Fidelity is not a publicly traded company. It's owned by one family, the Johnson family. And again, you don't even know what they're really worth and how much money they're actually making off of you. So when you think of annuities, I want you to think of when people have current 401ks with their current employer, 403bs or 457s, they're traditionally put into mutual funds. My apologies, I said annuities, mutual funds. Mutual funds are just made up of large, mid, small, and international stocks and bonds. I told you the rate of return is traditionally about 8%, okay? Now, these numbers are skewed because we don't know the true numbers of 2021, but we know where we're heading in 2021. And it's not going to be 26, 23, 24%. We already know where bonds were at. So what I'm trying to get at is these numbers across the board are going to drop starting next year. And I think they're going to also drop at the end of 2023 because I think the markets are going to stay volatile. So again, I want you to be weary of this because the truth about your employer's 401k is they're designed to benefit you. To benefit them, not you. The only time that you benefit from an employer's 401k is if they're giving you an employer's match. In my personal opinion, who cares about the employer's match this year and into next year? If I told you inflation again is at 7.7%, next year I think it's going to be a while. I personally feel it's going to take all of next year to probably get under 4 to 3.5% and a little bit into 2024. Okay. So the point is, who cares about the employer match when inflation's that high? Again, control. You're not in control. They're in control. They're designed through artificial restrictions to leave you misinformed, misguided, and you lose opportunities. Let's use Jerry's company, for example, GolfSuites. If you wanted to walk up to your brokerage firm or your broker and your registered investment advisor, and all you wanted to say is, hey, is it okay that I move over, let's say 10,000, 50,000, 100,000 over to into the alternative space to invest with Jerry? So let me backtrack 1 second, Jerry. Let me repeat that. I would like to use a portion of my retirement funds to invest with Jerry. They're going to tell you, no, that isn't part of the portfolio. You can't do that. But here are some other options you could take a look into. That is where they leave you, again, misinformed and misguided. What bothers me about brokerage, fiduciaries, employer 401ks is you cannot do what makes you happy, and you're tied into the market, and the market just keeps dropping while you're taking all of the risk. That, and again, it's how do I say this to you, except by just going straight into the next slide? It keeps you working. So if we talk about the last 12 recessions, right? And I'm not going to go through all 12 of them. So by 1952, there have been 12 recessions, okay? And let's look at the ones that are within our lifetime, all right? So if your goal is to retire at the age of 60, right? And let's just look at the dot-com bubble or the Great Recession, right? You're not going to retire at 60. So if you had $100,000 and you lost 49% of that, you're going to have to work an extra 4.6 years to get back to that 100,000. And if you went through the Great Recession, that's an additional 4.3%. So market volatility, your money being tied into the market because your employer doesn't give you control, is where we let you do what makes you happy with your retirement funds. So I want you to be, again, weary of that, because most people do not understand this. You're giving up time. The fee structure, Jerry, we know this, you know this, I know this. 58% of Americans have no idea that there's hidden fees. 18% of Americans don't even know where to find the fees. And if they do know how to find them, they don't give the actual calculations to you because they're worked into the statements. The hidden fees, these are the 5 most common that I want you to be wary of. Try to find them, try to look for them. And when you do look for them and you do ask your fiduciary or financial advisor or your brokerage firm or your HR department, they don't even know where to look for them. They're worked into the statements, and they could be very minute. And if you do find one, you're going to be like, oh, it's only 15 basis points or 25 basis points. I refer to these as termites eating away at your retirement. So these little termites, and if you do have a management fee or dealing with a fiduciary, typically tack up to be about 2 to 3%. And I'm sorry, these are the hidden fees. That's not including the management fee of the traditional 1%. Versus the IRA club. The IRA club has a flat fee model. It's $175 annually. It's $135 per asset. Before I get into Jerry's little fee structure, that is the standard IRA. We don't charge on percentages. I don't care if there's 10,000, 100,000, or 10 million. Not when your money grows up, their money. Not when you make money, they make money. And I want to break this down for you in a real simple spreadsheet. If you had $100,000 that you rolled over to IRA Club versus leaving it Fidelity, Vanguard, or Schwab, and I'm telling you to roll over the entire thing, I want you to understand where you're saving with us. It's the fee structures. So 10 years, the next 10 years, market volatility, everything's working against your retirement. You still contribute your 6%, so $6,000, because the average American only puts in 6%. Your annualized rate of return, simple math, we're always trying to create double-digit returns. 10%. IRA club fees, I just mentioned to you, is $300, 0.3, versus the Fidelities, Vanguards, and Schwabs of the world, or if you're using a fiduciary or financial broker, IRA club is going to save you just under $93,000. $93,000. Now, when you utilize a portion of your retirement funds to invest in the alternative space, because not, as I mentioned earlier, 32% of Americans in the 32% tax bracket or higher, which is traditionally the accredited investors that really do utilize this. When you think of your own personal funds versus tax deferred versus tax free. So tax deferred is your traditional IRA versus your Roth IRA. The only differences between the two is, when do I pay the taxes? That's it. Tax deferred in the traditional IRA, you're taking the tax deduction up front and you're paying the taxes later at the age of 72 years old, which is called the RMD. Next year, because of the Inflation Reduction Act, that will jump to 73. Versus the Roth IRA, you're paying the taxes up front on the seed. The growth is always tax-free for the rest of your life, your spouses, and your heirs up until 10 years. So let's go take the exact same numbers that we just did with the fee structure. 10%, 10 years, 100,000, same thing, 6% contributions. That $100,000 versus using your own personal funds versus deferred, traditional versus Roth. So not only are you making an extra $100,000, but IRA Club is saving you on the fee structure another $93,000. So this is the reason why you want to be able to consider self-direction and the process. Many Americans think this is a tedious or hard process. Jerry loves this about IRA Club. One of the things that we take pride on here is our customer service. It is a true system of checks and balances. Every single person here is assigned an IRA Club specialist. And the process is open, fund, invest. Opening your account takes 5 minutes. You could go to iraclub.org, go to open your account, choose the type of account, upload your driver's license. It scans your driver's license, takes you straight into the application, takes 4 minutes to accomplish. And the reason why I'm telling you this is there's going to be a section to say, how did you hear about us? And you're going to say Jerry or GolfSuites or ERC. And you know what he's going to do, Jerry? He's going to go ahead and cover your costs the first year. So again, why not give it a shot? Why not take a portion? That's my personal opinion. The next step is funding. Funding, 3 ways. Contributions, powered through Plaid, $6,000. Next year, that goes up to $6,500. So up $500. If you're under the age of 50, I'm sorry, over the age of 50, it's $7,500. This year, 7,000, next year, 7,500. Jerry, how much do you need to get started with your Reg A GolfSuites per share? How much is each share?
$13 now. It's $13 per share till the end of the month.
Till the end of the month. All right.
Right.
So what is your minimum investment?
Right now, $650.
Okay. So
average investment is, of course, much higher. Running
of
around
course,
10,000 or so. But $650 is the minimum.
Of course. So what we're talking about is taking $5,000 or $6,000, whatever makes you happy, lead it into the investment. We'll do the work for you. We'll open fund, and your job is to go to Jerry's team. We'll provide the investment docs, and that's how we go ahead and get started in utilizing a portion of your retirement funds.
Did you say Jerry's covering the cost on the account? That's pretty cool.
Yeah.
Jerry doesn't know that he's covering the cost until I told him that just now. No, I'm just kidding.
I wondered what those credit card charges are. No, we talked about this at the very beginning, and we're delighted to do this. I want to put in a plug for Remeza's company. There's an old expression, goes way back. It's important to vote, more important than who you vote for. That same theory applies here. I think it's key that citizens get a view of self-directing their IRA. That's the senior consideration of this webinar. That's going to the polls to vote. And once you get to the poll, I hope you vote for GolfSuites. But in all honesty, Remeza's company has a whole menu of investments. They are not allowed by law to recommend anybody. And it's a very, we have investors who were referring to IRA Club, and I'm telling my salespeople to convince the investors, to convince the participants to invest more at the IRA Club than just for GolfSuites, because there might be some other investments there. This IRA Club does a pretty diligent job of making sure their sponsors are good companies on their investors row. And so again, much like voting is more important than who you vote for, getting into the self-directed world is frankly more important than investing in GolfSuites. We just hope you do. And it's a great company. I'm delighted to have the IRA Club take up a major segment of time here, because it's a very critical piece of information that the vast bulk of Americans just have no idea.
Concept. Yeah. Concept of it. 100%.
Anyway, thank you. Great presentation on this.
Thanks, Ramez.
Thank you.
I got a couple questions for you guys. We've got about 7 minutes. We're running over. Let's top it off in 7 minutes if we can,
Okay.
guys. So, Jerry, a question: how can a company business plan be successful if they operate at a tax loss?
Well, the tax loss is what's called a soft loss grant. We get this question a lot. It's very heavily covered in our offering materials. Under current tax law, emerging companies like what GolfSuites is have tremendous tax advantages in building assets and then writing off a lot of those costs. Those are called soft write-offs. When you pay salaries and you buy food and you buy materials and you pay rent, lease, those are all hard expenses. Those are real expenses. But depreciation and amortization are soft expenses that go all the way back to the founding of the Internal Revenue Act. And given current tax law, which is incentivized to new business development, we're able to generate positive cash flows, not pay tax on those because of our soft cost write-offs. And when a corporation is not paying federal income tax, the dividends it pays are thereby non-taxable. So, that's really the answer. If you had to say, Jerry, put it in a couple of words, it's what you'd call soft expense. Soft expense is the answer.
And one concern that may have happened here as we, are in a recession from what Ramez just said. So we've heard that Top Golf announced that they might build in the city right next to you in Madison. What kind of alarm do you have, or what kind of planning have you got against that?
I feign a little, I wax a little humorous when I hear that. I've said in my other webinars that we'd be delighted to share a parking lot with Top Golf. I don't know that that's literally the truth, but it makes a good point. We're very close to them in Baton Rouge, Louisiana. We're probably a mile apart. We can see each other from our facilities. We're not going to purposely try to go in there. We bought our site in Madison, a Jackson, Mississippi suburb. They then came in right after us and bought a site. We're far enough apart that it just doesn't harass us at all. I mean, it's like Lowe's and Home Depot. It's like Staples and Office Depot. Down here, it's Publix to buy foods, or Walmart. There's really a lot of demand. Our facilities are going to be smaller, so they're going to be less of a competitive factor relative to volume. So we're just not concerned about that at all. We'll say this though: if we wake up with, say, 40 locations, my guess is 36, 37, 38 of them won't even have a Top Golf, because we're going to go into some smaller areas that they don't typically go to.
Thank you. So I'm going to throw this at both of you because I'm ignorant to a lot of this. This is great for me to know. So let's say I can invest in a large company. Let's just say I can take some of my money and do that. Why should I redirect some of my IRA? And then, Jerry, why would I want to do that with your company as opposed to going and buying a big stock somewhere? Because that's solid.
Well, I think the term solid is a real term. I think if you look at the New York Stock Exchange, you look at the NASDAQ over the last 30 years, clearly, on average, these companies are worth more. Alternative investing is an interesting concept. Grant, if you were to say, hey, I've got 300,000 sitting in a retirement account, I'm gonna put it all in GolfSuites, I'd say, no, you're not. No, I'm not going to let you do that. You have to be mindful of asset allocation. And having practiced as a CPA decades ago, I managed this for clients: asset allocation, spreading risk, and that's why IRA Club offers a whole menu of companies instead of just offering one or two. And so we're not going to sit here and say the stock market is bad. The stock market's a very key indicator of the American economy. It's a very key confidence indicator of the American economy. It will go up and down. But alternative investing is something which you put a little more to the risk side of the portfolio, manage the amount you're going to do there. If a person had 300,000 sitting in an IRA, all cash or cash and stocks, we would be very comfortable having them put 50 or 60,000 in with us, but not 150 or 200,000. Now, if they insist on doing that, we can't tell them no, but we can't advise them to. And of course, if you look at our offering materials, you see pages and pages and pages that talk about, getting their own investment advice. We are not their advisors, so forth. So I hope that answers that. We're not.
Jerry, just to add on to you, and just for me to hit it home, one of the things that I love, that's one of the things that I absolutely love about Jerry, again, and his team, is they're telling you what to do and they're being honest with you with what to do, right? You talked about $300,000, but to what's going on right now, every investment has risk. Everything that you do in life has risk, but we talk about taking educated, calculated risks. So it's a game of Monopoly. If you know that the stock market's going to stay volatile for the next 2 years, why would you leave all your eggs in one basket? That's what we preach: diversification, a portion of GolfSuites, a portion of whatever that makes you happy. But that's what I'm tying in when I talk about self-directing. The majority of Americans, which I feel bad for right now, their money's tied into the stock market because why? They don't have control. That's what Jerry educates. That's what I educate, is diversification. That's it at the end of the day.
To that end, Grant, let me add this. I know we're going a little over, but I think it's important data. I'm leaning on our salespeople very hard to have their new IRA Club arrivals move more money than their GolfSuites investment. understandably, my guys are interested in getting the shares sold. So somebody decides to do $20,000 in GolfSuites, he moves 20,000 of his IRA. I'm telling them, no, don't do that. Move 40 or 50,000 to the IRA club and let them, do their GolfSuites and do some other investments. Now that's, my guys have their own goals in mind is to sell our shares. So I'm kind of up against that, but I'm on record with that with the sales crew. We're all going to be getting together at our Tulsa location a couple of weeks. And you need to know, Ramez, I'm going to push that very hard. They're doing a better service for the client. Guy says, we just had a retired federal agent living in Baltimore put $100,000 into the GolfSuites Reg A. He has 400,000 sitting in his IRA. I said to my guys, why don't you move the whole damn thing? And they said, no, he just wants to do that 100,000. But I think he should put maybe 200 in and then talk with Ramez's people on the IRA Club Investor Row and look at some other stuff. That diversification is important at any level. So
and we have those options. Yeah. Once again, to add to Jerry's point, we have those options, right? We just can't choose those options. Again, it defeats the purpose, right? Otherwise, it doesn't make us any better than Fidelity, Vanguard, or Schwab. If you want to do the stock market with us, we have those options. But we want you not to put everything, again, in one basket. You want to do GolfSuites, ERC, precious metals, crypto, everything. Officially, what I like to think of IRA Club is officially a one-stop shop.
Yeah.
It's just, I can't choose the investment for you. That's it.
Right.
Cool. Well, gentlemen, thank you so much. This has been absolutely fascinating for especially guys like me, smaller investors, and the opportunities for both of these programs and what it offers us. Ramez, you already spoke about your website. Do you want to give it to us one more time?
IRAclub.org. You're more than welcome to schedule a call with me, top right side, or any one of my team members. As I mentioned, we're here to help you at the end of the day. And what you do from this point on is ultimately up to you. That's one of the advantages of what we do here at the IRA Club. And if you don't know the answer, call. We're not a call center. We have a receptionist. We're here to guide you.
That's pretty refreshing. Well, I'm going to put the GolfSuites stuff up here on the screen so you can contact Jerry and his group. And Ryan's one of his guys there, and he more than happy to talk to you. Again, gentlemen, thank you so much for this session. And we're going to go ahead and close it up.
Yeah, thanks for hosting us. Thanks for the
production.
Thank you, Grant.
Thank you, Jerry.
Guys.
Okay, guys.